ETFs and index funds are both great ways to invest, especially for beginners, but they're not exactly the same. Let's break it down so you can understand the key differences in just 3 minutes. Both ETFs, exchange-traded funds, and index funds are types of investments that aim to track the performance of a market index, like the S&P 500. Instead of picking individual stocks, you're investing in a basket of stocks or bonds that mirrors the index. This makes them simple, diversified, and cost-effective options. The key difference: how you buy and sell them. The main difference between ETFs and index funds is how they're traded. ETFs are traded on the stock market, just like individual stocks. You can buy or sell them at any time during market hours, and the price will fluctuate throughout the day based on supply and demand. Index funds, on the other hand, are not traded on the stock market. Instead, you buy or sell them directly through a fund company or broker, and you can only trade them at the end of the trading day based on the closing price. Example: imagine you're at a farmer's market. Buying an ETF is like picking up apples from a vendor. You can buy or sell them at any time while the market is open. Buying an index fund is like placing an order for apples at the end of the day, where the price is decided after all the sales are done. Flexibility versus simplicity. ETFs offer more flexibility because you can trade them whenever the market is open. They're great if you like the idea of actively managing your investments, or if you want to respond quickly to market changes. Index funds, however, are simpler. Since they only trade once a day, they're perfect for investors who prefer a set-it-and-forget-it approach. You don't need to worry about market timing or checking prices throughout the day. Costs: similar but slightly different. Both ETFs and index funds are low-cost options, but their fees are structured differently. ETFs usually have lower expense ratios because they're passively managed and don't involve as much administrative work. However, when you buy or sell an ETF, you might have to pay a brokerage fee or commission. Index funds don't have trading fees, but their expense ratios can be slightly higher than ETFs. This makes index funds a better choice for those who plan to invest regularly with small amounts, as they won't have to pay fees every time they invest. Example: if you're investing $100 every month, index funds might be more cost-effective because there's no trading fee. But if you're investing a lump sum, ETFs might save you money in the long run due to their lower expense ratios. Minimum investment. Index funds often have a minimum investment requirement, which can range from $500 to a few $1,000s, depending on the fund. ETFs, on the other hand, don't have a minimum investment. You can buy as little as one share, making them more accessible for beginners or those with limited funds. Dividends: automatic versus manual. When it comes to dividends, index funds automatically reinvest them for you. With ETFs, you have to decide what to do with the dividends yourself. They're either paid to you or left as cash in your brokerage account. Both ETFs and index funds are great tools for building wealth. The right choice depends on your investing style, budget, and preferences. If you like flexibility and lower fees, ETFs might be for you. If simplicity and automatic reinvestment sound better, go for an index fund. Either way, both options can help you grow your money over time.